Hello everybody, this is Brian here from quantlabs.net. We got 5 people aboard, ready to talk about, hopefully, some good risk management stuff. I'm going to leave everybody open. I won't mute everybody. So welcome. Oh, Sandra, I haven't seen her in a long time. So let's get started talking about some risk management. I want to learn from you guys so I know what to put in this system. Who wants to go first to let me know what your process that you use for risk management, what kind of functions or models or what sort of things you guys use? Anybody out there? Hey Sandra, I haven't seen you in a while. Everybody's unmuted just so everyone knows. Okay, don't be shy now. Just trying to find out what everybody's using for risk management.
Okay, Brian, it's Jeff from San Fran.
Okay, go ahead, man.
I just use a buy stop and a sell stop, right? And keep in the market all the time.
Okay.
And that means if you are taking a small loss, right, you can get it back. That's
Okay.
what I find to be the most useful.
So,
Most people put a stop. You put a stop in the system. Other people in the market to get the vendors can see the stops.
yeah.
Right. To get around that, what I do is in my system, I have what's called a buy stop and a sell stop.
Yeah.
Right? And it buys into a stop or sells into a stop. It constantly keeps into the market all the time. Right?
Mm-hmm.
And when I do that typically on, say, one lot, say on, I think, say, the euro, right? It'll only give me a loss of sometimes $300 or $400. You know what I mean?
Yeah.
Or it reverses and gets back that $300 or $400.
Right.
Okay. I find that the most useful without showing my hand to the market, like leaving a stop in the market, which brokers can see, things like that. Because I've had sometimes where I've had a really nasty move in the market, right, which drew down at 400, and then it's gone to a buy setup, right?
Yeah.
And then got it all back in the next move, right? So that's happened many, many times for me.
So that's when you let your broker know that you are applying a stop loss.
Well, no, it fires from my system, right?
Yeah.
It will take the loss, but go in the same direction as what the market was going,
Yeah.
right? With a buy stop or a sell stop,
Yeah.
right? So just to the broker, just like I'm taking loss on that, but then jumping into the market as well.
Okay.
It looks like that as the broker, rather than the broker sniffing out stops. And I've had situations over the years where I've put a stop in the market where, FX brokers or futures brokers,
Yeah.
the market goes straight to my stop. Right? So I'd rather not show that. That's why I built my system around. Like, I'll give you an example of something. Let me find one here. Take, for example, here's one here. So I went short. My system went short the euro. Say, for example, at around 126.62.
Okay.
Okay. The market drops down like I'm in profit, but then the market rises back up again. Right.
Yeah.
What I do is I enter in a long position to close out that short position, and then go naturally long as well. Right.
Yeah.
And the difference between that was actually like about 10 pips in the FX market.
Okay.
So it's always acting as, there's one here, for example, that I went long and the market went my way, then came back my way, and then I just went naturally short, right?
Yeah.
Covered that position out, and then went short myself, trying to catch back that money. That's what I do.
Okay.
Then I'm
So,
not showing my hand to anybody, basically.
so you basically, what I'm hearing is that you're using your system internally to apply its own logical stop losses. Am I to interpret that right?
That is correct. But I'm hiding it in the sense of not treating it as a stop. I'm just re-entering the market in the opposite direction to get back the lost money I've made.
Gotcha. Okay. Yeah.
But many times what happens is the market continues in that direction of what the stop is.
Okay.
You're wrong in the first place, right?
Yeah.
Catching back that extra money, right? So you don't lose money in that sense.
Okay.
And most of the time, markets tend to be in a range a lot of the time, right? So sometimes you get that back. The market's really in a rampant down move, right?
Yep.
You make loss, but you're getting it back because you're naturally short now, right? As the market goes down, you're getting that money back.
Okay. And when you apply your... Sorry, go ahead. Continue. Go ahead, Jeff. Yeah, I think so. Anybody got any questions? Anybody can chime in here via voice. Everybody can talk. Anybody get any questions? Somebody's breathing there. So what's this? Do you like what's the percentage of that internal stop loss do you apply to that potential trade, Jeff?
Give me 1 second, I'll tell you. 0.43, about 0.5% is the total risk of capital during those terms.
Now, is that for the actual? Go ahead, continue. Okay, so if that's the case, are you applying that percentage statically across each new type of asset, or do you have a little algorithm or formula you use to apply the percentage of that stop loss?
It's a bit of an algorithm, right? It's built into the system, depending on what the system is doing, right?
Yep.
Again, my system is, for example, today, the total of, what did it say? 31 trades today, 61.29% profitable, right? On
Yep.
one lot, $620, right?
Okay.
That's on one lot, right? On one lot,
Yep.
of course, down to one lot. So from that, it's a 0.43 loss, which means total loss at any drawdown points, right? Over the period would have been at 0.43%.
Okay.
That's total, whether it's long or short, that's combinational, right?
Right, but that's what I'm trying to learn is, like, at what point, if you're applying your stop loss, what sort of parameters are you using to assess that stop loss calculation?
Well, just think of it this way. If you build a system that's always in the market, make that assumption first, okay?
Yeah.
It's always in the market. And say, for example, I won't use, say, a simple moving average, but a lot of times you get a simple moving average, and you took the simple moving average, but market's going up, and cross the moving average, and we know all moving averages cross relatively late, right?
Yeah.
Many times when they do cross, you've already given up a lot of that, right?
Yeah.
So you're already making a loss on the top. What about you got at the top there? So you bought at the top, and then it crosses your moving average, right?
Yeah.
Well, wouldn't buy back there, right, to close out, because you haven't been short. You go short again, you close out a position, you go short again, then you're in the move down, right?
Mm-hmm.
And you make that money. Many systems I've seen don't have that premise, as I said before. The premise of the system is to have something called a buy stop, right?
Yeah.
And sell stop, right? Built into the system. Like mine got a certain time here and said, if such and such and buy expire at market, sell stop and sell short and expire at market.
Right.
That's what I'm doing.
Okay.
Right? And then I've got a market position there, whether how many contracts I am, how many they've got to sell.
Okay.
Because I find a lot of people, when they build the systems just with the entry and exit, right?
Yeah.
But don't do it continually. The best way to have a system is to build it continually, because that will capture any losses during the process. And you're just looking at what your net drawdown is.
Right.
The net drawdown I showed you, right, is a intraday value, peak to valley drawdown.
Mm-hmm.
My max drawdown is about half that, right? How much is it? It's just interesting.
Because I know, like, who's your broker right now? Are you at liberty to say? Are you using like a standard retail type of broker, like an Interactive Brokers, or?
No. Using one of the major banks.
Okay, so so you have other advantages. Like let's say it was like if I use Interactive Brokers, I can apply trailing stops, which other brokers won't support.
Yeah, but don't put the trailing stop, don't show the trailing stop, build the trailing stop into the system. So it just looks like a normal buying and selling system.
Right.
Don't post an order that that's a trailing stop, because that will go beforehand into the market and be shown to the broker.
Right, and then could you maybe verify on your experience that with some of the more retail type of brokers that they can trade against you because you do expose that trailing stop?
Well, I've been on both sides of the fence and I've seen what's going on, and you know, let's face it, a lot of them got data, how many retail clients are short at this level, how many retail guys got stops in the market at that particular level, right?
Mm-hmm.
Right? I want to give that all away to people, whether it's a bank or it's an institution, whatever it is, right?
Right.
So I just post, bought, the account bought at that level, 100,000 or whatever euro,
Yeah.
right? The account sold, that's all they see, right? And I manage that all internally within my system.
Understood. Now, in terms of what you're buying, are like part of your filter in what you're buying, you obviously got to make sure it's highly liquid, right? In case you do see, let's say, yesterday where there's a sudden panic at 3 o'clock or last hour, you know, you obviously don't want to be stuck with bad positions that you can't unload.
Yeah, well, you know, Euro's very liquid as Font said the other week, right? I agree with you, I use tip data, as I told you before, right?
Yeah.
And, you know, I'll give you an example between my time for 12:42. Remember, I'm in San Fran. I bought the euro, sold the euro, and bought the euro, and spent long the euro in the last couple of minutes, right?
Right.
Because the market got pushed up and then pushed back down again, right?
You're right.
Right?
Yeah.
You know, in fact, spot currency, particularly euro, if you do what Quant said, I think he's talking about 100 tick, right? It's very, very liquid. 100 tick on the, say, the S&P 500, it's just crazy, it moves too fast. But if the market doesn't move as fast as the yen, right, and you do 100 tick on that, that's fine.
Okay. Well, I'm just trying to understand, would you ever buy into any type of asset that, let's say, I know you don't do equity, but let's say for other people that do equity, is it a good measurement, would you think, that, let's say in my case, I want to calculate implied volatility on a particular equity. Let's say that equity doesn't have option data available to me. Does that mean that quite possibly that asset might not be liquid enough in case you do have a panic situation on your hands?
Well, you know, I like to get into the most liquid assets. Some equities aren't liquid. You know, if you really try and push the button, right?
Right.
Like on Columbus Day the other day, someone sold $730 million with a same futures contracts, right?
Yeah.
And it moved the market out, I think, 10 points or so, right?
Yeah.
So I can't pick the stocks, I don't do stocks, but in bonds are very liquid, bond futures that is. And the only things I ever do are futures or currencies. And the currencies I never use futures for. I always use, as your Quant said, always use, you know, euro, dollar, or, you know, spot currencies.
Right.
Those are very liquid.
Right, okay. Okay, I guess what I'm trying to just ask is, in your mind, if that particular equity doesn't have option data available, would you think that is a flag saying that is not a liquid asset?
Look, the big stocks are very liquid, I know that for a fact, and I know the options market's relatively deep. You know, but again, majority of people I think who do like do options in particular, from my basis, I used to work in the industry a long time, covered calls, right? You have a natural long position and you're selling calls against it, basically. And if it goes up, you can take a stock valuation, which is premium.
Right.
Okay. But you know, some of the SKU data is important in the equity market. Some of the actual you know, volatility of data is important. But I've built before a volatility-based system, okay?
Yeah.
And I've applied it to the market and had, for example, threshold for volatility had to break, right? And it worked for a long period of time. Okay, Brian?
Yeah.
Particularly, I've got built here already. and it doesn't really work on euro, it doesn't really work on CFA.
Yeah.
In some stocks, I haven't tried it, it doesn't work on those.
Right.
Okay.
Anybody? Continue, Jeff.
Pardon?
Go ahead, Jeff. Sorry, I didn't mean to cut you off.
No, I was just saying that I have built a volatility-based system, so the underlying weekly line, for example, is volatility, and volatility rate threshold, whether up or down, right?
Yeah.
Unfortunately, volatility changes all the time, and you're really on top of the system. Over a long period of time, it makes me money. Okay?
Okay. I know we're getting some background noise. If everybody could self-mute themselves somehow, so we don't get the background noise. I don't want to have to mute people. So that's good. I appreciate what you're contributing, Jeff. Anybody else got any ideas that want to add to what Jeff is sort of saying? I think this conversation is really good for people to walk away with some good experience. Anybody else and how they do their trading and how they apply whatever type of parameters that you'd use when you start putting positions on? What sort of risk management you guys use? And gals, I should say. Anybody? Everybody's all shy. Well, let me ask this. The other part of obviously risk management is how much capital you deploy on your positions. How people go about calculating their, let's say their upper or their self-imposed limit on each position, the percentage that they apply to for the position on the total portfolio. I'm trying to figure out how people do those sort of calculations as part of the risk management. Nope, I may have to. Yeah, Jeff. I said percentage. You can chime in again, Jeff, if you want.
Yeah, I do percentage. Just take capital, each trade allocate no more than 2% of my net capital.
Okay. And that's total, like that's the upper limit you put on a self-imposed trade.
Yes.
Okay. Yeah, that seems to be the standard. Now, are you also using leverage of any kind or margin?
Also watch very closely the margins. Okay.
Yeah.
I watch very closely, and I get emails. Everyone who trades should get an email from the Chicago Board of Trade, right? On adjustments of margins, right? It's called CME clearing. I got one yesterday, right? It's all member firms from CME, right? Bond requirements, right?
Yeah.
They change pretty regularly the actual margins, right?
Yeah.
If my collateral I have to post to the exchange on futures, right, goes up,
Yeah.
right? Then that will change my net dollar amount, right? I can actually put into an investment. Okay?
Right.
So I watch the margins at CME very closely,
Okay.
because that determines how much I can actually take into that 2% that I'm actually investing. Does that make sense?
Yeah. And can you like where would I go to grab those sort of alerts from the CBOE? I'll just bring up my browser here.
Yeah, on the CME website, under CME Group Margins, everybody, I don't care who you are, if you trade in security, you should keep an eye on what the CME is charging members. If, for example, they start raising up the evening futures margin, right?
Yeah.
Right? By
Yeah.
$5 or something. That means that people can't play the market anymore, right?
Okay.
That means there's starting to be a big move in the stock market or whatever,
Yeah.
right? That's a bit of an implication, but everybody on the call can sign up for free at the CME Group.
Okay, and that's under clearing, right?
They're clearing, correct.
Okay.
And the clearing margins.
Okay.
Get a margin note.
Okay, and this is as
If
you
you give
said.
me your email address, Brian, I'll send you a copy of my last one.
Oh sure. Yeah, you want my email right now?
Well, I can send it to you after the call if you like.
Okay. Yeah, I can post it for everybody after. I can definitely do
It
that.
comes from server within CME, right?
Right.
And it comes from the server. And if you email on the server, send it out to all member clearing firms, chief executive officers like me, back office managers and margin managers, right?
Okay. Okay.
And
Good
then
to
takes
know.
to a PDF of all the things that have actually changed.
Okay.
Okay.
And any person in the public can get this information.
Yes.
Good to know. That's really good to know. Thanks a lot for that tip, man.
No problems.
Anybody else?
In equities or bonds or FX or anything, you should keep an eye on what CME is doing on the margins. It's very important.
Right. Could you also use that as an assessment on in terms of risk that could work against you?
Yeah, it is. For example, if they double my margins, right?
Yeah.
Say on a week or something, right? Overnight. It means CME is fearful what could happen in the next couple of weeks, right?
Yeah.
That means the rates up, I haven't got X amount of capital. Instead of doing 5 lots, I'm down to doing 3 lots because of double margin as with the exchange, right?
Yeah.
Means I have less money, so then when I take 2% of that, I'm only really buying one lot. Does that make sense? Rather than buying a couple of lots or four.
Right. Okay, that makes sense. So, anybody else got any ideas, or they can throw out some tips on managing their positions on the percentage that they'll allocate from their capital on any new position? What's the sort of upper percentage you put on that position of the total portfolio? Oh, Jeff, I'm not sure if you got George's question. It's in the chat box. He asked, do you...
I close them out always on Friday night, George. I hold no positions over weekends.
And so you do hold positions overnight though, but not going into a weekend.
Always close those positions, about 20 minutes before market shut on Friday.
So you could open a position on Monday and hold it until sometime on Friday.
I open up a lot of positions on Sunday actually.
Okay.
Into Europe, right, and stuff like that. That's where
Right.
I turn my system on. 3 o'clock on Sunday, I turn my systems on.
Okay. And what's the average hold times you put on your system?
Euro. The average hold time is, let me tell you, not that long. Average time between trades 31 minutes.
Wow. Okay. So you're pretty classic intraday.
Yeah.
Okay.
Average time between profit peaks is about an hour, right? Long trade 36 minutes in the trade. Short trades are in about 22 minutes.
Okay.
That's an example of the Euro trade.
Okay.
Because remember, you're dealing with 100 ticks, right? So, they're pretty quick.
Of course.
That's what your quant said in London he used.
Right. Yeah, he's pretty...
Same as me. Same as me, basically.
Right. Anybody else got any comments on, again, the percentage of, for each position, what your self-imposed limit would be percent-wise for each position against your total portfolio? I'm looking for other limits that you put on yourself.
Right.
Go ahead.
Ryan, can you hear me?
Yeah, go ahead.
Jeff, I have one question. I might have missed it. When you talk about you build your orders into the system, are you always placing market or limit orders?
For me, I'm not doing any trading right now, but if anybody else wants to answer that question.
Yeah.
Did Jeff? Market or limit orders?
Mine are always market orders, because limit orders don't sometimes get filled, so I do add market orders.
Right, okay. Yeah, I wanted, because I saw that you were building it into the system, I wanted to make sure I understood, because otherwise the limit orders may not always be quick.
How do you deal with slippage from market orders?
Well, by having a fast feed, that swaps some of them. Having a feed input co-located computer, that's why.
What kind of size are we speaking about?
You don't get a lot of slippage, you get some slippage though.
Well, it depends on the market, how much liquidity there is in the market, and that changes over time, so it's really, can be hard to manage.
But I mean, what kind of positions are we talking about? How big? Because for here, you can feel a couple of hundred millions in the first 5, 10, 20 lots. So why are we speaking about slippage? Because you said that you are trading through a bank or some prime mortgage, I understand. So I don't understand why one lot's a problem for not doing the market order.
I do think it would matter, no, on the type of access like the General Joe would have. If I'm wrong there.
For one lot, that's hugely small.
Yeah. All right.
I mean, even for limit orders, it's still small. I mean, and in the first place, if you're trading through PP, you put it as an iceberg order, so it will be hidden. So why someone would be scared about hiding orders? You have different access of 5 different orders through PPs. So
Yeah. Just so people know, that's Mr. LQ speaking.
I think it depends what platform you're using and what instruments you're trading. I wouldn't want to do market orders with options. I don't think that's a good idea because the liquidity in a lot of options, while some of them are high, they're not going to be as high as Forex or SPX futures or ES futures. But even with like S&P 500 futures, there's a risk of slippage. So, you know, it depends. I guess with currencies, it's a little bit, you know, it's different.
but I mean, futures depends on the size, but you can easily get something like close to 2 million, 3 million easily without any slippage. So I mean, I don't understand why slippage is a problem because most people here understand they're retail people. So
I could imagine during the flash crash that people had market orders in at the time may have been very unhappy with their fills. Right?
that's the story that happened once in a million, right?
We don't know.
Once every 7 years.
A flash crash? Well, I mean, these are electronic markets now. I mean, they're new and they're getting more complex. So, I mean, even though it's only really happened once in the past, but people are suggesting that it could happen more and more as the technology gets more and more complex. That's the theory.
Well, yeah, but there's also shock events that you can't really plan for either, right?
I mean, but that's the problem though, when you have a flash event and you haven't put an order as a limit order, which at least it has more chances to be hit than trying to hit yourself. You carry more risk than not putting any limit orders at all. Oh, no, sorry, any stop losses at all.
So what are you suggesting, that people should use stop losses, or does it just depend upon the situation?
You have to do both. You have to carry, in my opinion, you should do both stop losses and have also your own system that you still track stop losses as a minor override.
Right. So I guess what
it's also the same way with the take profit. Take profit is always a limit order.
Yeah.
So there's no guarantee that it's going to be hit. So that's why it's ideal that also you have your automatic take profit from your side as a market order.
Right. Because these are the sort of things I'm trying to decipher and learn from. Under what scenario do you not apply a stop loss, and what scenarios do you apply a stop loss? The only time I can see myself ever not applying a stop loss is if you're in a major rally. You don't want to be stopped out at the upper limit, right? Sorry, I didn't get that.
Brian, I think you always need to have a stop loss because even if it's a major rally, you don't want to give back your gains, right? In case it gets volatile and it takes a dive down, in the interim, right? You want to lock in as much profit as you can. So.
Right. I mean,
You always want to have a stop loss because you never know what's going to happen, right?
right. Well, I mean, I'm just saying in case if you have a solid rally, you have a system that can assess risk as best as you can. You know the momentum's going in your direction. Hopefully, you wouldn't want to apply a stop loss because you don't want to be stopped out on an upper movement that's going to be consistently happening over a couple of days or even a couple of weeks.
You mean you say you just rely on your system? Your system has told you that the next couple of weeks there has to be a rally, and you have 100%, 95% confidence.
Something like that. Yeah, that's what I'm trying to figure out. Is like, if that scenario was to take hold, what sort of scenarios and what kind of parameters would people use to sort of like be able to apply that and implement that into their system? So that's what I'm trying to understand. Is like, what sort of parameters do people use for those sort of scenarios?
Hey Brian, Jeff, use something like a percentage up or percentage down
Right.
of what your system, whatever it has to do, and then that acts as a normal entry and exit to the system.
Right. No, I understand that, but there's got to be a lot more set of parameters that you would use. Obviously, use classic stats. I don't know, ATR is a good one.
Right, I was just thinking about that.
Implied-
ATR is probably one that people would use for stops.
Yeah, and implied volatility, and any other ones that other people may be using that I'm not even aware of. That's what I'm kind of looking for. And so other people can, not just myself can learn, but other people can learn too. So if anyone else has got anything else that could be used, that'd be awesome. I know that you could use all the fancy quantity stuff, but I don't know. I mean, those are pretty complicated models, right?
That's the advantage of options, though. You don't need stops because in some option positions where you're not selling naked options, you don't really need stops because you know what your max loss is. So you can kind of position size and only buy or sell according to your risk tolerance or money management.
Right. Well, the thing is, I think if you're building automated trading systems, I mean, I'm sure Mr. L, whoever out there can attest to it, is when you look at the markets, you want to maximize every entry, every position you put on, that you want to maximize that return. So you don't want to just focus on options. You may want to play into different assets when the market opportunities present themselves. So I guess what I'm saying, I just don't want to be limited to just options. You know what I mean?
Right, I think for the other assets, you always need stops because you have to prepare for a black swan event, which your system cannot detect by definition. So systems cannot detect black swan risks. So you have to have some doomsday stop, maybe it's 20% or 25% away, but something, right? So that you don't have a catastrophic loss.
Yeah. And I guess on the other hand, if you have with the logic that you're applying, like let's say you put a position on and you automatically put a stop loss on of let's say 10%.
Yeah.
I mean, wouldn't that minimize your risk of loss?
Yeah, I mean, it definitely should unless something really funny happens in the markets and the liquidity dries up and there's a free fall and the stop gets hit but it doesn't get triggered because there's not enough liquidity and you wind up getting out at 20% down instead of 10%.
Right.
So you really have to judge, you have to assess whether the market can have a liquidity black hole. What's happening? Like for the stock market, we know that definitely can happen. For Forex, I don't know. Commodities, I'm not sure. Probably can happen in some commodities as well. So you got to prepare for that.
Yeah. I guess George made a comment about it's better to focus on a few products, know them very well. Any comments? I'll put it out to everybody. What's your thoughts?
I agree.
You agree? Eh?
I definitely agree. I think that if you focus on too many different financial instruments or assets, you can kind of lose your edge. You can kind of lose track. Unless you have a really good automated system that's going to track everything for you.
Yeah.
So I agree.
Anyone else got any opinion on that?
I agree, focus on one thing first, know that very well before you step into something else,
Yeah.
Like one of my friends tells Jeff, trade S&P 500, and I say, no, just concentrate on what I do,
Well, let me ask you this: for you, Jeff, why would you not want to focus on equity? Is you're more familiar with bonds and FX?
Yeah, well, I've brought up on bonds, right? I've bond trader for a long time.
Right.
And I was also an FX trader, and I understand those two markets very well.
Right.
Try and understand what an equity is, and understand what an option is, and understand what dividends are, and blah, 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 blah. But if I try and apply my systems from the euro, right,
Yeah.
to that S&P 500 contract, right, it struggles to work,
Right.
right? So I don't suggest that you can take one system and apply it to multiple asset classes. It just doesn't work.
Right.
I
Exactly.
found one it works across multiple ones. So I'd rather keep the things that I know, right? And I know, for example, that at 4:30 my time here, agents coming in and someone's going to push it in Tokyo one direction, and it's, little things like that which you learn from your experience.
Okay. I think Edwell asked a question. Does anyone use a variation of optimal F for risk management? Might be a little above my head. Optimal F. Does anyone know what optimal F is? Or is that a typo?
I
Anybody?
think that's, go ahead.
No, go ahead. Go ahead,
I
Sean.
think that's where you try to optimize your Kelly fraction or Kelly ratio to get optimal results in your trading.
Okay.
So I think that's what it is.
If Edwell wants to chime in and hang on here, I think he may be accidentally muted. Hang on, Edwell, if you're able to speak. No. If you want to unmute yourself, Edwell. We're just trying to understand what your optimal F. I'm just looking it up on Google right now. Optimal. So there's a book here. I've never heard of this. Optimal F. There's this book here called Optimal F from Book on Dummies. I have no idea. Anybody ever seen this?
I'm seeing it now.
Yeah, I've never seen this before. No, Mike, relevance, optimal F. Am I wrong here, Edwell? If you want to just give me a link on this topic, Edwell. We'll come back to that in a second.
I'm going to send you the, oh, you're already looking at it.
Yeah, that's for the dummies.
Yeah.
If anyone wants
Ross
to,
Vivek, he wrote several books on money management, so he describes optimal F in detail. If you're mathematical and you want to get a rigorous introduction to it, then, he's got a couple books. But the Dummies book is probably better for a beginner.
right? Yeah, that makes sense for me.
For you, this would be a good book.
There you go. I appreciate that, man. This is great where I can learn stuff like this. Thanks, man. I wish I could give you a better answer on it, but if I can't give an answer if I don't know it. Anybody else using anything else that might be different or that we might not know? I mean, there's Kelly Criterion. Money management is good to know. Does anyone actually use Kelly Criterion in their active trading on their next trading opportunity? See how much capital they deploy on their next position? Jeff says no. So Jeff, you're not using Kelly Criterion at all?
No, just my system just tells me what risk it is and everything, and I look at the drawdown. I just look at drawdown, that's all I look at.
Right. Okay, George asked, go, continue, Jeff, go ahead. Go ahead, Jeff.
No problem.
Sorry, I don't mean to do that. I guess George asked, does anyone use support and resistance? Anybody would like to answer that in their systems?
No, but I do know people out there who use support and resistance. I don't know, but I know some people who use support and resistance in trading.
Right. You were going to say, Shalom?
Just for risk management purposes, not for estimating future price movements.
So, like, is that when you use it for when you have a position on?
Yeah, I might get into a position if I see like the 100-day moving average is being tested,
Okay.
and it's like the fourth time or third time it's being tested, then I might take a position. Or I might take a position if I see that the 100-day moving average is broken, the 200-day moving average is being tested.
So do you
Just a place to go to get it. Go ahead.
So I was just going to say, are you using it for as part of the, we'll call it your screening process? Like do you just watch a certain set of predefined assets, or do you have like a system that picks
Not really a
up?
screener, it's more like it's like a trigger.
Okay.
It's like it triggers a trade, where you have it set up already, and you know these moving average levels when they get hit, that can act like a trigger to get into something.
Right.
Yeah, that's it.
Okay. So I guess like for you guys, do you watch just a certain set of assets, or do you have a system that watches like pretty well a set of sectors, and then I'll just pick out what looks like a good trading opportunity, or are you just watching, let's say, 10 or 12 set of assets, fix that set of assets, and that's it? Or do you have a system that dynamically chooses what may look good at that time? 'Cause I'm just going to bring out a link that I've been working on this. Anybody? Jeff or Shalom, do you guys just use a set of predefined assets that you guys watch?
I have a predefined list of a watch list that I look at.
What about you, Jeff?
I have a predefined list of futures contracts
Okay.
and a pre list of currencies that I trade.
Okay, so I'm only bringing this up for George. This is what I've done. I've just put this out on Friday. As you know, I'm building out a system. I basically have a watch list that I use that will watch anything, and it's a screening process that will, once it sees something on the watch list, it'll then put it into a position management sort of scenario where it'll put the position on, and then it will start using things like support and resistance. And part of this video, I'll put the link in if anyone's interested, is similar to support and resistance, but it's just using average, a trend line. So anytime that trend on the current price breaks the trend, then it will use that as a potential trigger to enter in as a position. But it's not just using trend line, but it's also using moving average and a few other set of parameters. So if you want to watch that, that's how I'm doing it. I don't know if that answers your question, George. Anybody else got any questions or comments so far? This is really good.
Interesting site.
Okay, so George asks, you have tried back testing the system? Yeah, well, back testing is a weird word, George. Everything's going to be paper traded, and basically what my system is going to focus on is just risk and reward. I've got a whole slew of notes I put up on my site on how the system's going to work. But what it's looking for, things like momentum, it's looking for things like, as I said, risk reward, and it's using ATR and a few other set of parameters, applied volatility. Everything has to be forward looking. It's also using fundamental analysis like earnings per share as part of the guidance. So there's a variety of different factors that I use that will be used as a set of signals that will say, yes, this position's on. And trend line is one of them, which is a form of support and resistance. Let me just check out your link, Shalom. This is Optimal F, looks like?
Yeah, and Kelly.
Oh, and Kelly. Okay, cool. And George asked another question. Does anyone have any guidelines on back testing? George, are you able to speak? Oh, from risk management. George, if you want to unmute yourself, you might want to I could give you an idea myself, but I'll let other people. Oh, not today. Okay. Anybody else got any ideas on backtesting and how they use backtesting?
Who uses backtest?
Sorry, Jeff, we didn't catch you there. If you,
I use backtesting and walk forward, and sometimes what I do is using my, I'll talk about it before, my Hilbert sine wave with the polynomial I mentioned on another call. Right, I check to see if that current backtest and walk forward is close, like the cells are where that selling and the buys are in that.
okay.
And then what I do is I take the best of both of those and I use that for my trading. I haven't found yet a pure way of taking backtesting and walk forward on a very short time period, right, that works. So I have to blend it with my Hilbert sine wave polynomial, right,
Yeah.
to check whether the signals match to that.
Okay.
Right? But I do it every day.
Yeah, sorry. Jeez, sorry. I was trying to look for a video here. Yeah.
So you use a polynomial to walk forward on and see if that matches your backtest?
No, I have a system that I built, okay, that's based on something, right? We've got a percentage up and a percentage down, that's how it enters.
Okay.
So what I do is if I run it through a back test, right, it comes out profitable, don't get me wrong, right? But what I then do is I match where the buy and sell signals are happening relative to a Hilbert sine wave, one of the lines, right, with a polynomial, like a fourth degree or a 1 degree or a third degree polynomial.
Okay.
And when those signals cross, it should then give me a red signal up at the top. My system should tell me I should be selling when they're crossing, right? And for example, today I had a cross on those two right on the end of the day on the euro, right? And that all matched together, and that's why I sold, I let my system sell the euro. But then at roughly 12:37 San Francisco time, the Hilbert sine wave polynomial crossed, and my system gave a buy signal, and I took that buy signal as well. So what I'm doing is I'm just doing double confidence, you know what I mean? Just checking a back test and walk forward system against something I've always used, which is my 1, 2, 3, 4 polynomial against the Hilbert sine wave.
Okay.
Because Edwell was mentioning here of walk forward as well. I mean, if you're needing a good tool, George, I would recommend Mr. LQ has asked me about backtesting engines, and I've always responded with TradeLink. It has a way to automate backtesting through the legacy code. I'll try to pull up some code for it if you're interested in that platform.
What I've found is even during the course of the day, using just normal 100 tick or whatever on the euro, the walk forward optimization, which was optimal, say at 6 o'clock in the morning in my time, right, will be outdated by about 9 o'clock. Okay?
Yep.
The market's moving so fast in 2014 that it's changing the walk forward optimization that you pick a couple of hours into the day.
Okay. I just put a link in here on TradeLink backtesting, how you can use it. Using something called Codetopia, which is one of the apps built in. Hopefully that'll help you out, George. What did you get, Shalom, out of the so far on this Optimal F? Did you get anything new?
No, I'm still looking, but that link has the R code in there for testing, so that looks like it might be very interesting.
Okay.
The R code is accurate. You never know with this free stuff, but...
Well, some of the stuff I've seen on R can be pretty good, especially if it's coming from RBlogger. Again, if it's valid or not, it's another story. I think I've played with this maybe. Looks familiar. Let me see if there's a RBlogger link to this. Anybody else got any questions at all in the meantime?
No, just be cautious of backtesting more for everybody.
Yeah. Well, there's a famous book by
I've got
Prando.
friends of mine, machines that are running it every minute, right?
Yeah.
For example. So, just if you're trying to do it yourself and think it's going to be the DMs all your life, then switching it. There was a big run of switching the algorithms today on the Euro at 10:20 this morning, right?
Yeah.
And there was a big run where they changed the algorithm. I think it was around midnight on the 13th, right?
Yep.
And there was another big one on the what day was that? Check what day it was. Give me a second for that. It was on the 13th on the Euro. They did a major switching around of the algorithm at approximately 1 o'clock in the afternoon.
Okay.
Okay, I know that because that's when some of my systems, get chopped around a bit.
All right. Yeah, Shalom just put in this Elite Trader. Do you guys use this one book from the Evaluation of Optimization of Trading Strategies from Robert Pardo? He's supposed to be the godfather and all this stuff.
Yes.
You believe in it? You believe in this book, Jeff?
Yeah, I do, but I have to check it, as I say, against Hill with Polynomial.
Okay. Okay. Just try to put out resources out there to see what may work or what may not work for whoever's interested. Ed Wall says it's a good book. Yeah, I think he was the guy who wrote the whole concept of block floor theory.
He said the machines at the moment are running it every couple of minutes now these days, compared to you at home running it once a morning for each trade, so just be careful.
Of course, yeah.
Okay.
Anything else at all for people? In terms of risk management, is there anything else we haven't attacked or talked about? How do you guys feel about portfolio management? Hedging, very good. What do you say, George? Maybe he doesn't. I guess it depends on the type of strategy you use for hedging, no? What I'm learning is market, sector, and then the actual sector risk as well. So you need to know how to hedge all three out and know how to minimize the risk at all three levels. That's if you're trading, obviously, equities. What sort of things do you have to hedge out in terms of fixed income or futures? Jeff, would you say?
Well, if you've got a position and it's going against you, you can always do a bond option against it or something like that. But hedging is really if you've got capital and management wants you to be square every night, right?
Right.
And you want to hedge, right? So I run my systems from 3 o'clock on Sunday all the way through to 2 o'clock on a Friday, 1 o'clock on a Friday, my time.
Right.
And when I was at the investment banks, when I worked for some big banks, my manager always wanted me to hedge my book by the end of the day, right?
Okay.
And by hedging it, I mean I took my net duration, for example, my duration risk in bonds, and then if I was short duration, I would go and buy futures against it, right?
Yep.
And I have to go and buy the equal amount at face value, again, the same risk quality, right?
Yep.
Of those futures contracts against a short position I might have had in the market.
Okay.
Right? But no, if you're running your own book, right, and you're going to hold it overnight and you didn't want to let it do, you'd hedge it overnight with futures. If you're running futures, then the only way you can really put a hedge on is really do shorter futures or longer futures, or use a butterfly, right?
Okay.
Because otherwise, curve risk, right, and that can be very, very dangerous if you don't know what you're doing.
Good to know. These are things. That's why I'm thinking: is it wise? Well, obviously, like from my perspective, I'm not well versed in futures or options, so that's why I'm kind of more exploring these other courses to sort of get me up to speed to understand those sort of movements and that sort of I guess money management, risk or management, as well as hedging all that out. So that's why I'm obviously thinking I have to start learning that sort of stuff. Does that answer your questions, George? I mean, if you got any more questions, George? Anybody else got any questions or comments at all?
I have one question.
Yep.
About using a system with the Hilbert wave or whatever polynomial to measure the walk forward risk or test the walk forward prediction or future prediction. What kind of statistical tests do you use to check for errors between the two?
What I do is I run a walk forward, okay, and then what I do, back test first, and from the back test I do a walk forward, okay.
On the walk forward stuff, what type of statistical tests do you run?
Well, it's got everything from ask-R and all the other stuff and standard deviation and blah blah blah. But what I care about is I just look for the most profitable set of parameters, okay. And if I punch those parameters into my system and it lines up against my Hilbert sine wave polynomial, then I know I'm within the ballpark, right? I'll give you an example. Currently, there's a euro long position my system says to stay at the moment right around 340 today, right? Euro's gone slightly lower and come back up. My Hilbert sine wave polynomial, right, has not crossed yet, right? Therefore, it drifted back, right? So, it was just another sign when, cyclical work again is coming to play in the marketplace, which is very important. And the system picked up the signal too early because it's a system, right? Now, I'm sure it'll come back into profit, it always does, but it drew down probably about, 5 pips or something, not much at all, right? But the Hilbert polynomial hasn't crossed yet.
Did you say 5 ticks or 5 pips?
5 pips.
5 pips, okay.
Yeah. So it hasn't drew down much, but it drew down, right? And I know that it was going to draw down because, it was Asia and they was pushed down first and then pulled back up. But, I haven't yet had my Hilbert sine wave against the polynomial line across yet.
So what is your max? What's your max drawdown for your system before you hit a stop?
Max drawdown is 0.4%.
Okay.
So it's not much.
No, it's very small. All right, that sounds reasonable. Thank you.
Well, that's okay, but a few other things. It has things like, like that's a 30% annual rate of return, right? It's running about a bit over 2% average, loss, right? And it's about 63% profitable. I make it more profitable because I actually sit here all day and watch it, and sometimes don't take the trade because the polynomials and the Hilbert hasn't crossed yet.
Makes sense? I guess so. I'm just trying to see if there's anything else I'm missing. George asked about to raise the discussion of hedging. Has anybody else got any questions on stuff like that? Anybody? So, in terms of exiting a position, like I'll be trading out with equity. What sort of things do people use as a measure to exit a position? I mean, even Forex or even futures. Anybody have anything that they can contribute at all? And that's the most. I mean, are most people using something like a stopwatch just to automatically stop them out, or how do most people do it?
No, it can take you out.
Sorry, I missed that.
Let the system take you out.
Okay. Well, that's yeah, I understand that. But what are the parameters that you're using to enable that?
A proprietary system that's like a wiggly line that's going through a percentage up and a percentage down. Like, for example, why they gave the long trade on the euro was my algorithm went above that line.
Okay.
The stop in line, right?
Right.
So it got me an average position, closed out the short position, and went naturally long.
Right.
And underneath that wiggly line at the moment is the red line, right?
Yeah.
That the market drew down towards, and now has bounced from that. And now we're back into money again.
Okay. Anybody else?
Building a system, Brian, create, say, a wiggly line out of your whatever you're going to build as your algorithm, right?
Yeah.
And then just percentage up and a percentage down around it. And set that percentage and percentage down, I don't know, 0.8, 0.9 away from the actual line itself,
Right.
right? Give opportunity for your thing to actually move without touching it. That's the best way I've known to build a system.
Right. And that's the thing is like once you breach those parameters, then you just let the system automatically, essentially stop you out, right?
No, or do a reversal trade, one of the two. Don't stop you out.
Okay.
Why be out of the market? And you're not making money when you're out of the market.
Right.
Stay in the market all the time.
Right. Anybody else got any comments on that? Edwell says he uses a target exit based on previous SRR and trailing stop. Okay. So for you, Edwell, are you using an internal trailing stop that you track within your system? Because we already talked about exposing trailing stops to your broker.
I keep it all internally, right?
Yeah.
And ensure the broker buying and sell.
Yeah. Hey, I'm about to sneeze. I hate when that happens. Sorry. Excuse me about that. Okay, responds, no, not yet. I use IB, but we'll change that from what I heard today. Yeah. Yeah, that's something I'm concerned about as well, Edwell. I'm new to all this, to be honest, and you know, it's somebody says like Jeff's experience says, use it internally within your system. Yeah, that's something I would recommend. I've seen and heard that multiple times. Seems to be the gospel. Anybody else got any questions or concerns? I mean, we've been doing this for an hour, which is not too bad. Anything you'd like to add, Jeff?
No, I'm pretty good actually.
Yeah,
I've gone up and I'm now.
I appreciate your contributions to this. It's really helpful. If anyone else got anything that you'd like to add, I don't know, Shalom or George, anybody else we haven't heard from at all? As I said, I'm just trying to put these together just so I can learn and other people can learn as well. I mean, we've already learned about this optimal F and some other things as well. Yeah, Edwell says, thanks, Jeff. Good input. Yeah, so it's good that everyone's learning. Anybody else might have anything they can share? I'm just looking for anything new I might not have seen. Shalom, is there anything you'd like to add at all or as feedback?
I think we covered a lot of stuff. It seems that optimal F isn't really something that serious traders use.
Okay.
In my reading. So I think because from what I've read, it has to do on your largest loss in the past.
Okay.
And that's really not a good benchmark to use going forward.
Okay.
I mean, but there's stuff all over the internet on optimal F. I've read reviews on Ralph's books, and that always comes up. Optimal F is a constant criticism of
Yeah.
something that is a theoretical thing, but in practice, in actual trading, doesn't really work very well.
Well,
I have to look into that some more to see exactly why. but,
okay.
you know.
Anybody using things like beta as well as a measurement of risk against your portfolio? Anybody believe in beta?
Beta is just a correlation, right?
Yeah.
It's how yeah, I mean, so with correlation, the problem is the correlation can change, so you have to constantly be recomputing the correlation to see if there's correlation creep, to see if the things that you're hedging that have not been very correlated are starting to get correlated. The one problem is in certain markets where you have liquidity black holes, the correlation can happen very, very quickly.
Right.
So it kind of defeats its point as an indicator, beta, when your indicator can change quicker than you can manage your position. Well, then that's not a good indicator, right?
So when you say that, are you referring to it changing over an intraday or a multi-day process?
No, over minutes.
And then, okay, well, what happens? I mean, let me ask people. For most people, how long are they holding their positions? Just give me a yes. How many are actual intraday traders and only intraday traders?
31.
31 minutes from Jeff. Anybody else do just strictly intraday? So Edwald says he's intraday. I know you, Jeff. And how many of you actually hold positions overnight? And just give me a yes on that.
Yes.
Okay. Anybody-
Yes on overnight. Yeah.
Okay, so if that's the case, if what you're saying about beta is only going to change over a few minutes, would that affect if you're holding positions for, let's say, a couple of days, a couple of weeks?
Well, yeah, because it could change within a few minutes and then it could stay that way. So you were counting on two assets being uncorrelated or inversely correlated, and then they become very correlated. And that happens over a course of a few minutes, and then it stays that way for days or months.
Okay.
Weeks or
So
months.
when the correlation, for how long is the length of that time series? In minutes or in days?
You mean the initial correlation? How?
Yes, because you're calculating the correlation on some length of data. How long is that?
I would use 200 days.
Well, mathematically, you cannot get something correlated within minutes if you're using 200 days correlation. Like, it's impossible, mathematically impossible.
Right. But I'm saying that's true.
If
In other words,
you're doing 10 minutes, then suddenly you're using, in the last, let's say you're doing, 10 minutes part. You have the last part, maybe it may get correlated, but if you're doing 200 days for the last 1 minute, have correlation.
right. In other words, you have to wait.
Ooh.
What's going on?
I know that's background noise. Sorry about that.
Weird. No, I'm saying in that case, LQ, you would have to wait 50 days or 100 days to see whether you're correlated or not, right? In other words, there's a lag time, right? Wouldn't there be? In other words, you couldn't recompute it in minutes. So that makes it even worse because there's a lag time. So by the time you properly compute it and it's correlated, that now what do you do?
But this goes against what you were saying before. Because before you're saying something says immediately, something immediately becomes correlated.
Well, I mean, it's important to run correlations on different time intervals. So you want to run it on 200 days, on 100 days, on 50 days. Firms that look at correlation, they look at it on all different time scales, right? So they're computing all different correlation measures. So they're computing, they may do hour by hour, they may do, 10 minutes, but then they also do 10 hours, they do 10 days, 10 months. So it's not just, they're not going to look at just one measure, at one time scale of correlation. These firms, I just actually sent Brian that there's a TV series called Hedge Fund Lion's Den, where hedge fund managers go ahead and compete in front of investors to get capital.
Yeah, I get that.
It's a fake kind of thing, but in there was an emerging market fund where they invested. Brian, did you see that in a whole bunch of stocks? And they were trying to explain to investors how they manage correlation risk?
No, I haven't watched the show, but I'll pull up the link for anybody who's interested.
Yeah.
Keep going.
Yeah, Give everyone the link, because it's actually a good show, even though it's not real. There's no real money being invested. It's just for instructional purposes. It's still interesting. But this firm was measuring correlation creep at all different time scales, because that was the one thing that could really kill them. They had a diversified portfolio of small cap emerging companies across 8 countries. So LQ, if you've never seen that, it might be interesting.
I mean, but these guys are holding stocks for ages. That's a big difference between being worried that something going to change the last minute. If you're holding stocks for that long, you're much more worried about news or just when the stock market is on trade.
Well, but I mean, if there's a stock market crash like in 2008, then what happens is all the stocks tend to get correlated.
No. I'm not referring to the stock market crash. I'm referring to that something when a CEO dies, that company goes down the toilet. That's a big difference. And that can happen during the night when something's on trend. Then suddenly you wake up in the morning, you open your monitor, and because there is also the pre-market auction, that stock is already down.
So the CEO dying is kind of like a sort of like an exogenous, almost a black swan type of risk, not a correlation risk per se, right?
Well, I mean, for me, it's a risk that, I mean, it's one of these cases that you cannot do anything about it, but the person is there. So, I mean, for me, that's much more realistic at that point, because it can happen more frequently than anything else. Or in the same way, some CEO sells his shares, kind of early, and everyone just goes there to take down the company. That's not a black swan. I mean, that's happening more frequently.
It's not a black swan in absolute terms that a CEO is going to die sometime in the future, because everyone is going to die sometime in the future, or most of us anyways. But to calculate that the probability of the CEO is going to die like on the next day, tomorrow, that's a very, very low probability, so that would be a black swan event. If you're just looking in the immediate term, in the future, of such an event happening, the probability is very small, right?
Okay, but see examples with which was it Tesco? That was this slight mistake of 200 million pounds on the accounting. That happened in reality. I mean, that was found, during late hours, and that was something that just put down the stocks a bit more. So I mean, let's say I cannot see errors, which happened now with Tesco, for example.
Right.
That put down the stock like crazy. That wasn't released until the morning, but then when your body got in.
I mean, you're just elucidating reasons why trading single stocks is probably more risky than other types of instruments or assets. And it's one of the reasons I don't trade stocks, is because you never know. There's so many risks. There's operational risk, which includes accounting risk. There's fraud. There's black swans or catastrophic events if the CEO dies. There's legal action. There's all kinds of stuff. There's so many different risks that can hit a single company that it just makes it much more risky or volatile to be involved in single.
Right, but on the other hand, though, in trading, I think from my perspective, people like to trade indexes because they're safe. That's fine if you want average returns, but if you want maximum and highest potential returns, you have to take risk in trading the actual equities themselves.
Yeah, I mean, you just have to understand that you're taking much more risk than you would if you're trading an index, and then manage it from there somehow.
Right, and that's where it's important that whatever parameters you use to measure your risk is critical.
Right. I mean, that's why hedge funds, what they'll do is they'll invest in lots of companies, and they'll try to weight them and balance them appropriately, and make sure that they look at the correlations. And they're looking at the correlations like they probably are looking at it like on a second by second basis with computers. They probably have alerts set up to see if anything changes, within seconds. They need to know about it right away. But I mean, even this company in this Lion's Den video or TV episode, they said that they could only get out of half their positions within like 4 or 5 days within a trading week. And the other to liquidate their 90% of their account would take like more than a month.
Yeah, but the question is why? Like, why does it take so long? Is it because their assets, whatever they're putting positions on, are not liquid enough?
Well, yeah, it's a small cap emerging market, so
Right. So that's what I'm saying is
impact, you know, that's the problem.
that's what I'm saying is that probably their risk management isn't really working for them if their performance isn't that good, you know, overall.
No, I think their alpha was okay. I think their alpha was reasonable. It wasn't bad. It was just that their time to their exit time to get out of all their positions was long, because I just think because they had a significant amount of capital in small caps, emerging small caps.
Yeah.
So the liquidity isn't as great as if you were in larger caps and in established markets. So. You know, it's just it seems very risky. Although they in the show, not to ruin it, but they raised the most amount of capital from the investors. So I kind of ruined the show for you guys. Sorry.
That's okay.
It's still very educational to watch.
Oh, for sure.
Yeah.
But again, you also have to factor in economic conditions. Like, is it if they hired a monkey to do the same thing in an upward trend, would the monkey have done just as well? You know what I mean?
I mean, what really makes the TV show sort of fake, really fake, is that they're not dealing with real money. So when the investors are not deploying their own capital, so they can basically do whatever they want, right? So it doesn't necessarily have to make sense.
Yeah.
But it seemed crazy to give those guys $40 million in capital when it takes them more than a month to exit 90% or 95% of their positions.
I personally, from not even watching the show, I think they'll get slaughtered at some point. I mean, I couldn't see themselves putting in a trade in Thursday XYZ and then they're going to be able to get out. They would lose their shirt for sure with the markets the way they've been, right?
Right, I mean, it just takes some serious bond crisis to spark a fire, and all of a sudden yields go up, and everyone rushes into bonds. Nobody cares about stocks anymore. People dump stocks like crazy. All those emerging market stocks go down, and they're left holding the bag as they try to get out of the market. So that's, you know, it doesn't seem like a good strategy to me, but.
Well, I've seen people put a lot of effort into developing strategies. It looks good on paper, it looks good when they test it against the broker testing account or demo account, but once they put it live, it dies within, minutes.
Brian, this one didn't even look good on paper.
I don't know.
It's kind of educational, but it's
Sure.
now.
Sure, but it comes back to that sheeple mentality where you get all these thousands of people thinking that's how they'll trade, and they'll apply that into their own systems or their own methodologies, and then wonder why they're not doing all that well.
I would hope that no investor would take a look at this Lions Den TV, web TV thing and try to invest based off what they learned.
You'd be
I
surprised.
hope they wouldn't do that.
Yeah.
Let's hope so.
Yeah.
It's more entertainment, I think.
Right. I mean, Gigi brought up that BBC show, and it's exactly what you said. Just entertaining, and it boggles my mind what people do without real full education on what they're.
There was one interesting thing that I learned from the show is that investors care more about alpha than they do about risk management. And the reason is because what they do is if they like an investor, but they think the investor has really bad risk management, like he's using VAR, all kinds of bogus, risk measures.
Yeah.
What they'll do is they'll say, we'd like to use your trading signal, but we're going to use it within a managed account. In other words, we're going to get our own risk manager. And then we're going to combine that with your trading signals, your trades, and use them together that way in a managed account. So that's what they do. So if you're looking for outside investors, if they think you have an interesting trading strategy and they like your alpha, your return, then your risk management isn't that important because they'll just ask for a managed account and do it that way. So for your own trading, risk management is the most important thing.
I agree with that statement.
But not if you're trying to sell to your trading strategy to investors, then alpha is the most important. So I found that very enlightening.
Yeah, that makes sense because there's a lot of pension funds out there hurting, but at the same time, they're under a mandate to, bring back a certain amount of returns so that they take any risky strategy just to attain that alpha that they need. Anybody else got any comments or questions? We're almost an hour and a half here, which is great. Hope you guys are learning stuff.
LQ, are you still there? Yeah, I was curious, what kind of statistical measures do you use to manage risk? Did you,
Hypothesis testing. Hypothesis testing on the forward results.
okay.
Otherwise, it's bullshit. I mean, if you're going to go mathematics here, but seeing some engagement doesn't mean you have to do some hypothesis testing, different type of measures to see what are you saying is it statistically correct or not. So, for example, one thing that some people will use with the SAT the t-statistics. Because otherwise, I mean, for example, when you use before guys about Pardo's for me, it's like a bullshit on the platform.
Yeah, I kind of figured that.
What was, I'm sorry?
Pardo's is the biggest bullshit on the platform. He practically and nothing out of Pardo's really works because you're trying to find efficient coefficients like that.
Yeah.
At some point in time, once upon a time, maybe 15 years ago, when he really got his book, these was working, the market was very slow, everything was working nicely, and people weren't reacting. Not many participants. Yes, momentum is working, not anymore.
Right.
The biggest losers right now are the momentum strategists, unless you know how to trade them. So.
Ed Wall put an interesting book on. I mean, I've seen a lot of these things, but this is good for newbies. If anybody is interested, thanks, Ed Wall. This is really good. I'll definitely take a look at this.
And most systems that are using CAs to optimize parameters are based on Pardo's. I haven't seen many people using these kind of systems to make money.
Yeah.
Otherwise, it was not straightforward. Everyone will be making money.
I'm only bringing him up because he seems to be the guy who started this concept of walk forward testing or whatnot.
Yeah,
He wasn't even the first guy. This is like a typical thing of any type of model. This is like one mathematics from whenever you were doing econometrics theory. You take a model to work forward to see the stability of the model. And he was just trying to apply the same thing on a global or on a black box formula of a strategy.
Right.
Well,
I mean, from my perspective, I do realize there's a lot of newbies on this session, and people will be even watching this video, and I'd say 90% of them are newbies. So the whole purpose, as I said, I'm one of them, as you know. So I'm learning here, and there's other people that are farther along that will be using other resources or developing their own. So we all have our different opinions. Actually, Shane just said, I have a comment on type of risk. Indexes with leverage are better than single stocks. Single stocks have too much incalculable risk. Using leverage with index futures gives better return potential and risk that can be measured. Shane, are you able to talk? I'm interested in this comment. Anybody at all?
Can you hear me?
Yeah, go ahead.
Hey, yeah. So just a comment you were making earlier.
Yeah.
That going to use single stocks because indexes are a stable return.
Right.
I think, if you add the juice, you can make any instrument crazy. So when you buy a futures contract on the S&P, you're really at 90% margin. So that's where one tick of volatility on a futures contract is the same as a 3-month move on a stock.
Right.
And it's important to know that difference. That
No, I understand.
indexes can be just as wild as anything else.
But I'm just trying to understand. Are you saying that you need to use leverage to achieve that?
Well, just on your comment earlier, I think you were saying that, you know, if people buy index funds because they want an average return.
Right.
But
Yeah.
I would just say you can buy index funds because you want an outsized return that you can understand the risk of. Because if you're to say the risk on, you know, name a stock Apple next year,
Yeah.
there's so many variables that you can't measure.
Right.
All the systems we're talking about is all basically measuring the past to guess the future, right?
That's what I'm trying to. Are you more of a retail trader, or you actually build automated trading systems?
Well, I'm automated retail. So I'm a software developer by day, and I'm an Interactive Brokers TWS API guy by night.
Okay. The only reason I ask that because most retail traders would probably like say that, but way I look at it is I'm focusing on long and shorting like a typical in a pair trading strategy. So obviously, if you can maximize via what you calculate as a long and your short, that's all I'm saying. And you typically obviously won't get that with indexes. That's all I'm saying.
Right. Well, and in the case of 30-minute trades, if you're doing individual stocks, you're kind of limited to just a day's trading hours. as well.
I totally agree. And my system does not do intraday. It does holds of 30 to 90 days.
Okay.
That's like so. Yeah, we're different animals there. That's for sure. But again, I completely hear what you're saying. I'm just trying to interpret what you're saying though with using index funds with leverage. I assume, right?
Yeah, well, I'm just more talking futures contracts today.
Okay. Yeah. Again.
Yeah, it's a E-mini is an index fund.
Understood.
Well,
Understood. Understood.
not exactly.
Yeah. Because I'm dollar for dollar. Like with this type of strategy that I'm using, we'll have no we'll be using no leverage whatsoever. Just pure classic trading. But it's, as I said, it's gonna do a position time horizon of 60 to 90 days. That's what I'm seeing. Let me ask you guys, do you guys believe in 100% spending your time on day trading? If you understand the definition. Go ahead.
Yeah, mine's 24 hours a day, except for the weekend.
Okay. I'm just trying. The only reason I ask that is just due to the fact that as I learned this, would you say you're more managing your portfolio, or are you more managing your trading ideas and putting those on? Like, what are you spending more time on?
My algorithm 20 hours of 6:30 and say 8 o'clock.
Right.
And then my Australian operation is managing from 8 o'clock until 6 o'clock tomorrow morning.
Okay.
Because in case something goes wrong, I have a big red button, I can turn it all off. That's what I do.
Okay.
I would say this, take your blood pressure. If your blood pressure can handle you trading around the clock, by all means, go ahead and do it.
No, just a 12-hour day.
12-hour day? Yeah, I mean,
12 hours.
right.
So are you literally sitting in front of your system 24 hours, or do you have it sending out alerts to you?
I'm watching it or I'm getting alerts anyway of everything that goes on my phone, and I'm typically watching it.
Okay.
Yes.
Okay.
So trading is the most boring job in the world.
Yeah, that's what I hear, especially on quiet trading floors and banks and hedge funds. And everyone seems to agree on that. Thanks.
No, I don't, but I don't day trade. But I think if you're day trading, maybe it's more.
Yeah.
Why? Because a lot of times markets aren't that volatile, right? It's like watching paint dry. Nothing's happening.
Right. Yeah, I agree. But go ahead, Jeff. Go ahead.
Yeah, well, Europe's big, so bonds move a bit, and most currencies move every day, so I'm happy about that.
Yep. That's why people do it. It's fast moving. What was I going to say? Yeah, I mean, people say it's boring, as Edwell says here, but where it's not sexy and you're making good money at it, what does it matter, right?
Typically,
Yeah.
I'm
So
sorry.
you can't let the system run by itself, right? You've got to keep an eye on it, no matter what happens, right?
Oh, no, I agree,
You're
I agree.
monitoring other markets, you're watching not just one market, you're watching multiple markets and just managing your money, that's what you're doing.
Yeah,
So that means sitting there and running the bathroom and taking a phone where you're watching it and using like a go to my PC to watch your screen even if you're walking out to get a coffee or whatever, right? That's what you do.
totally. Yeah. And you're about to say something, Shalom?
Oh, I think most of these trading system guys, when the market is slow, they're doing research and they're, tuning their systems and looking for new strategies. And then they prepare for when it's volatile, like markets are these days. So this is the time when they actually actively trade. And then when markets go dead again, then they go back to research. So this way it never gets boring.
Well, I think the research part is what excites a lot of people.
And also trading during volatile times is very exciting as well.
You know?
Thus in the last few days.
Yeah, I mean trading, if there's volatility in the market, trading can be very exciting.
No, I think both trading, like my trading is pretty just normal, it's not exciting. I don't get excited by trading. I think if you get excited by trading, you're in the wrong business. Right? Because it should be a business and you shouldn't get excited about it. It's just making your money and that's what you're doing.
I agree, but I think every now and then people look at their results, they do get excited. I mean, even when they have a good chart, it's exciting.
I agree. Not minute by minute, but yeah, at the end of the month when you look at it, you might have a bright smile on your face,
Exactly, it's not something you should depend on for excitement in your life. That's
Correct.
right.
That's
We all agree on that.
the fringe benefits of what the extra cash can bring. That's what excites you.
If you're doing this to be entertained, then it's not the right, it's probably not the right thing for you, right business.
And don't forget, there's always Vegas. There's Vegas as well.
Yeah, well, Vegas is, you're better off buying a lottery ticket than going to Vegas, right?
Great.
Well, people go there for the excitement, right? They get free buffets.
But that's the food.
Right, so it's entertainment, right? Okay.
Yeah.
So you're comparing apples with oranges, right? We're talking about business and that's entertainment.
Right. Exactly.
Correct.
Yeah.
Yeah. Wow. Who knew this was gonna be part of risk management, eh?
I'd say this is the order. Yeah.
They're sharing one thing in common, though, both in Las Vegas and stock markets are equal number of losers.
There's an equal amount of losers.
No, there's equal number of losers.
Equal number of losers.
Oh yes, true.
Because trading, no matter what, is a broad emotion, it's an educated company.
Yeah. But
The moment that you're using moving averages, it's an educated company. You don't like it?
Yeah. Yeah. Again, I think although the newbies, that's what they start with, though.
yeah, I mean, just judging by the type of books that are out there, like Pardo's book, right, that some people, not everyone, but there are a few good reviews on Amazon for his books, so and his book is basically nonsense. So there's so much bad information out there on trading, it's no wonder people lose money.
Well, I just
So
find,
much bad information. Terrible.
I just wish more and more people would be able to develop their own tools, to be able to do their own research, be able to assess their own data, their own trading ideas, instead of relying on other services and other people, and just be able to do it all on their own. That's
Well, but Brian, nobody does it on their own. They all talk to other people. When they research, I mean, they're reading books, they're reading papers, they're going to websites, they're talking to people, right? So nobody does this on their own. I mean, we all are dependent on some information, right?
No, I agree. That's why I do what I do right here.
Yeah.
I just, but it is dangerous to rely on from other people that may be relying on information that could be bad.
I think Meetup's a good, Brian, because it brings out a discussion about everything, right? And
Exactly,
basically what it
yeah.
does,
Yeah,
it brings things to the floor.
yeah, yeah.
Yeah, I mean, you have to have good common sense filters within your mind. And then you take all the information in and then you filter out all the bad stuff just by your own life experience and common sense. And that's how you can be profitable, hopefully.
That's correct.
Yeah. Yeah.
Don't rely 1% on your system, it won't work.
Right. Fair enough.
Rely 66 on your system, which is what it states, and then add your extra 10% on your own, looking at something else.
Right. But what would you, from your experience, Jeff, or even Mr. LQ, out of the percentage of your total trades, how many would you say ideally you should shoot for to say you're a good trader? Like, would you say 50% of your trades should be winning? Should they be 2/3?
60.
You said 60? 6-0?
60 minimum.
6-0. Okay, that's what I was thinking too.
I would say most one.
Yeah? So in industry, what would it be? 50% or even lower?
No, most of my friends do the similar thing under 60 somewhere.
Yeah, I'm figuring 2/3 of your trade should be, yeah, exactly what Edwell said, about 65%. I'm saying about 2/3. Does that make sense?
That's correct.
Okay. Good to know.
But really, what you want to measure, you really want to measure P&L, not how many wins you have, right? Because you could have, you know, you could have a lot of wins and one loss that kills you, right?
The
Sorry,
win-loss ratio,
go ahead, Jeff.
win-loss ratio is very important.
Yeah, that's all part of the Kelly criterion. I just think that,
Loss, right?
yeah. Well, let me ask you this. Do you think a lot of traders lose money just due to the fact that they hang on to losing trades too long?
Well, I'll give you an example. I've been to some of the trader conferences in Vegas, right? Just
Yeah.
as a professional, right? Sat next to some retail guys. And just ask a couple of questions of retail guys and ask them, so what are you reading at the moment? Are you successful in your day trading? Blah, 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 blah. And about every single one I've talked to is already going down the wrong road. Right? And I said, let's go and have lunch. And I took the guy and had lunch. And this guy was Arizona and, insurance guy, wants to branch out into that. And I just helped him, get on the right track, right?
Yeah.
The question really becomes, there's so much disinformation out there, it's ridiculous.
Yeah.
Right?
Oh, I know. I see it all the time. But do you think the key behind it all is, even if you're sitting on a losing trade, the key behind it is to assess that losing trade and cut it loose as fast as you can, so you can minimize your losses?
I think the best thing you can actually do is you get some software which you can easily get, and it records your trading day, right?
Yeah.
You go back in your trading day and watch where your signals were and watch where your whatever you're looking at, like indicator, whatever it is, and you go through that every single day. That's the best way to learn.
But that's for people that are making trading decisions based on intuition or experience or emotion.
No, it could just be a moving average or whatever you're using, Brian, right?
Yeah.
Just see every time, because when you see it in real time, you're actually there watching it, and you go back and watch the video, you might see it differently. Now I see some different things.
Yeah. My light bulb just went on when you just said that. Exactly.
I have a lot of big hedge funds that do that in their trading, when they're teaching people trading. They videotape it and they say, you're going to take a decision there, but look what happened. That wasn't there yet, that wasn't there yet.
Yeah.
And that's why you have to draw down the position.
Yeah.
Right?
So
But you don't help record it, right?
So
I record all my stuff every day, just to make sure.
So I'm just trying to understand how you operate. Are you operating 100% on automated processes, or are you just allowing them to generate the signals and then executing manually?
No, I let it about 80% of the time work automatically, right?
Oh, I see. Okay.
Sometimes I'll say, no, I won't take that signal because, or I'll take the decision and I'll trim the decision a little bit because the market's going to, my Fisher transform polynomial has crossed it.
Okay. Yeah.
But today I didn't touch it at all. The only trade I touched to manage like that was the one that happened at 4 o'clock today.
Okay.
The rest was automatic.
Good to know. I mean, yeah, I'm just trying to figure out where people go wrong on the majority of their assessment on when they go into a trade, when it starts to go against them. And from what I'm learning, the best time is if you see it losing, just get out. And that's what your stop loss is for, I would think.
Right, I mean, either traders are gonna lose a lot of money because they have a lot of small losses,
Yeah.
or they took a few really big losses, right? Those are the two ways it happens.
Right. I guess that's what I'm trying to say is that you're trying to reduce those big losses, though.
Right, but I'm saying you could also lose a lot of money by having a lot of small losses, right?
True, but then
1,000 small losses, right?
Right. But if you're designing a system, like in my case, from an automated way of looking at it, you're hoping that as you start paper trading it, you'll see conditions that will put you in a loss, and it's those conditions that you want to say, okay, if this is the case, this is the scenario, cut that trade very quickly, and at some point you're going to have a lot more positive winners. That's
Right,
what
you define your risk beforehand, and then you look for a very positive win-loss ratio.
yeah.
The thing is that when you paper trade, you're not going to be simulating market impact, right? This is no
I
market.
won't get split stuff.
Right. Understood.
I'm sorry, go ahead.
Go ahead, Jeff.
No, like slippage, and you won't get the real data. You know, like I programmed mine only to trade if there's real data in the market.
How do you simulate for market impact in the real life testing? Is there a way to do that?
Yeah, there is a way. There's a way of always in a particular system to do a bit of coding that says only trade if there's real data on the screen, rather than fake in a sim account, right? Sim account in every system I've seen is really fake data, right? It screws around the trading system, right? You can write some code in particular ways, you know, to say if that data is true, if you are seeing true text, then trade.
I think the live paper trading systems is actual live quotes, as you would see in a real-time system, in a real trade.
No, I've got multiple vendors, trade station, other people that it sometimes it's delayed, sometimes it stops, sometimes it's.
Right.
Don't believe what I say. Get into a real market, Brian, and do a trade there first to see if it's real.
Yeah. What I'm planning to do is to use a broker that enables me to put trades on of like $5, $10, and just see which direction it goes, so that I'm not gonna like the thing I'm learning from what retail traders is they'll have $5,000 in the account and they'll just start trading like crazy, but they're not understanding the real market flow and on the impact on those trading ideas, where they're just pouring a ton of money into from their account right up front over a week or two, and I think that's not the right way to do it. So how I'm looking at it, just put $5 on, $10 on, and just see where it goes, so you can test the market flow, as you said, the market impact, and see what happens to that trade.
Yes.
Right, you may have to put a few bucks in. You know.
Yeah, but like I'm looking at, I don't want to. If I'm with IB, let's say Interactive Brokers, good broker. I mean, for me to shell out 10 grand, and then take on that risk, and for whatever reason, there's another broker here in Toronto, Oanda, which is good just for Forex. You could put $100 in the account, and you can put like $2 in the trade, and see what happens. It's like like minuscule bets, basically.
Yeah.
And that's what I'm planning to do. I just wish retail traders, from what I've seen, were able to use the same kind of concept. I guess Edwell said that he said positive expect.
Well, I mean, there's a lot of forex brokers that'll give you.
Go ahead, Sheldon.
There's a lot of forex brokers that'll give you a free demo account. You don't have to put a cent in that. You just get it for free.
I understand that, but I don't think it's the same when you start putting money into it. It's like going into a casino.
Yeah.
It's like watching people how they bet, but unless you have skin in the game yourself, you know what I mean?
No, so at that point you can open up a live account and put like whatever, $50 into it or something.
Yeah, exactly. Yeah,
Uh-huh.
yeah, because
You can do that with trade stations, but you can do it with a whole bunch of forex brokers.
yeah. Well, but then you have the other problems of other things as well that could, work against you. But I think for me, Oanda looks like a good little broker to test around with. Anybody else? Comments, questions? We're coming up to almost 2 hour and 45 minutes. Pretty good. Anybody else got any questions about risk management? What about you, Mr. LQ? You have any input at all or anything you'd like to add?
Well, I don't think that speaking about market impact, unless you're doing some proper mix houses, you have any difference.
Yeah. I mean, I've seen some simulators out there that you can use, like open source ones that you could probably connect the system into and have it mimic market making and all kinds of adverse conditions on your
Right,
trades.
look on the tight currency, and I think that people that haven't really traded proper one haven't seen exactly how it works. On the proper currencies, let's say Euro USD, from a normal PB or a proper PB scale like EBS, for example,
Yeah.
you have to buy minimum 150 million to move it 1 pip. So I don't understand why slippage for some people is an issue. I really don't get it.
Yeah.
So if someone is trading like 2 lots, what will be the market impact? Nothing.
Yeah.
Practically, what will happen from the top level of the order book, 2 lots will just get out of whatever size it is. In the worst case scenario, we'll move it 0.1 pips.
So what you're saying is people shouldn't need to worry, like especially small retail traders shouldn't even have to worry about these things.
Not at all.
Okay. Good to
I think
know.
for options, market impact is a much bigger thing than for stocks or currencies. But, when you're dealing with...
For stocks, actually, it's worse. For stocks, there is a reason. Because there's not enough liquidity. That's a different story. And also, with stocks...
Options are even less liquid than stocks, right? So...
No, exactly. Well, it depends where you go for the options and which market. Okay.
Yeah.
Well, there's a reason why the biggest market making activity takes place in the options market.
Judge, so just hang on.
Typically the spreads for options are a lot wider than they are for stocks.
Yeah, but there's a good reason, because options are very expensive by its nature, and also because of the nature of what you're trying to do there.
Yeah.
Just
This
so,
is true. Options are going to be more expensive.
just so everyone knows, Jeff is just signing off. Thanks again, Jeff.
See you, everybody.
Yeah, thanks a lot for
Yeah, everybody.
contributing, man. It was
Bye.
really, really, really helpful. Thanks. So we're down to 7 people. How many people are actually talking? I know Edwell's typing. We got M. Wiseman, Shane. I think the only person we haven't heard from was M. Wiseman. Anybody else want to add anything about risk management or comment on it? It's a huge portion.
Yeah, I think another topic to Shane here.
Yeah, go ahead.
We haven't discussed is, in the 60 to 90 day system, which is interesting, you only get 3 or 4 shots a year, right? So how do you, if you're not going to hit your 60% target ratio, it's going to take you a year to find out if you're okay. Whereas if you're trading, say, 100 times a month, you'll know a few weeks in if your stats are right.
Right. I mean, for my system, what I'm doing is I have a watch list. I'll have probably who knows how many trading ideas, and it might only do one position or one trade a month. Again, it's one of those things I wouldn't know. And again, I'm really tightening up the risk management side of it up front. So it's nothing is guaranteed to know if I'll ever get 2/3 or 50% profitable trades. I wish I could say I would, but you know, all I can say is I'm trying to reduce that risk up front.
I'm in the same boat.
I just think there's the right way of assessing the risk and the right way of assessing the market direction. There's numerous things that people have at their disposal that are very simple, but aren't really applying it. You know, they get caught up in these quant models and all this math and all these fancy schmancy software things, but they're not really boiling it down to the very basic indicators that they can use at their disposal.
Yeah.
And
Well, I
that's
think basic indicators really don't tell you a whole lot because everyone uses them, right? Basic technical indicators is something so many people look at. There's no information edge in just looking at those indicators alone without understanding.
I agree.
I think so the problem is that there is no scientific basis for most technical indicators.
Right, I think, like I was saying before, I don't know if you heard, a lot of sophisticated traders just use technical indicators as triggers to manage their position.
Yeah.
You know, when to get it. They don't use it for any kind of analysis like predictions or anything like
Exactly.
that. It's just like a risk management tool that they use to trigger trades.
Or they're just confirmation of when to enter a position.
That's what I said, a trigger. It's
Yeah,
basically,
yeah,
that's what
yeah,
a trigger
yeah.
is. It's a confirmation that at this point they should get into the trade.
See, but that's
and
the problem.
analysis was done outside of that.
Yeah, but that's the problem with a lot of these technical traders, or that they just watch charts and they use that as a form of entering in a trade. You cannot generate trading ideas from watching charts. That's the point. That's the point, and that's where a lot of retail traders fail. So there's the right way and the wrong way, right? And that's why
Looking at charts is probably destructive because it paints a picture where you actually think you know what you're looking at. You know,
Well-
the story, it basically paints a whole story for you. You think you have the whole big picture, and you don't.
No,
And
you
that's-
don't. You don't. You're because you're watching something that's in current motion, and by the time that opportunity opens up while you're watching charts, that opportunity is already passed by the time you enter your position. And by the time you enter your position, guess what? The people that forecasted it maybe a week or 3 months prior are using that liquidity that you provide as their exit. That's what the professional traders are doing.
Some of them at least, yeah.
From what I'm seeing, a lot of them, that's how they do it. And that's why, unfortunately for retail traders, they're needed, but they're not needed for the right reason. You know what I mean?
For liquidity, for exit.
Right, the liquid. That's why they call it the dumb money, because it's the dumb money that allows the smart money to get out. Because the dumb money provides that liquidity so that they can get out.
Right, so dumb money, we'll rename it as exit liquidity providers. How about that?
However you put it, but that's the difference.
Yeah.
That's awesome.
But I guess, Shane, that's how it is. It's just people don't like to hear that. But there's people out there that'll argue the market, and then I get it all the time. Why can't I make money at trading? It's because they're arguing the market. They're expecting the market to work the way they want it to work, but yet they're not spinning it in a way where the market's presenting these opportunities, and they're just kind of missing it. You know what I mean?
More to the point, they're thinking like everyone else who's losing money in the markets.
Exactly.
Exactly.
Yeah, the sheeple that lose. That's the problem. It's like people on Quantopian or whatever others, those type of cloud platforms. They'll watch, and they're just really just chasing stocks. No different than joining Tim Sykes' alert service. And that's
Basically, they're trend following.
Right. Or swing traders, or these guys get killed all the time.
Sure.
And that's how I look at it. It's the wrong way of doing it. But they'll still argue with you and blah 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 blah. I get it all the time in my local meetups and blah. You know, I don't know. I go on about it, but whatever.
Well, I mean, some of these methodologies work for a period of time until they get killed, right? There are people doing it for a reason. There are some people using these methods that just incidentally happen to make money, coincidentally. With
Sure,
them,
sure.
or
But
in
then,
spite of them, right?
right. But
So-
then there's a dumb money that follow that, thinking that they're going to profit too. And yeah, you'll profit. The market's
Right, what I'm saying is that sometimes dumb money makes money before they lose a ton of money, right?
right. But as we said, your winning ratio, you need to, let's say if you're trading for 5 years, every single of those years you need to be winning 66% of the time. That's what the goal is of trading. And a lot of these people may get lucky at the beginning, but they're not most likely going to be getting 66% win ratio.
But it doesn't matter 66%. The only thing that matters is your return rate and your volatility.
Right.
Your volatility as a drawdown, also volatility within the trade.
Right. I'm just saying that they need to understand why they're winning and why they're losing. That's all I'm saying.
I mean, most people,
Let's put it a different way. You may have, say, 80% return rate. You may have, I don't know, almost zero drawdown, but it happens that your drawdown within the trade can always be very high. So how will you evaluate this as very high?
Right.
It doesn't matter if you win. Your potential of losing within the trade, even though you won it, is very high.
Exactly. Yeah.
So most people will see only the volatility as a result. Okay, I won the trade, but okay, what happened during the trade? Okay, you may didn't lose it, but it doesn't mean a thing.
But I guess the question is, okay, so you put that down as a pattern, right? That's a pattern of how the market works under those conditions. And then you get a million of these different patterns, and you can use those to refer to make a trading decision, because there's this pattern out there that happened 5 years ago, let's say. And that works, but again, the key then is you need to make sure that if you're going to trade like that you got a really fast system that can do that pattern matching, I guess. So I guess, is there any point to look? Well, it's important to learn why you fail at a trade, but I don't know. It's just, I don't know. There's different ways to slice it. Anybody else got any comments?
I think the important thing is one thing that Ted was saying before, that was important in the sessions. Just write down all your trades.
Yeah.
Simple as that.
Yeah.
And if you want to do it as a game, just print out your trades or the part of the chart before you trade. It's not hide the date, hide the time of the day or whatever. Have a little flashcard and see how would you forecast it without knowing what's the instrument or anything else.
Yeah.
That's called human pattern recognition. It might work better.
Yeah. I mean, like I said, there's different ways to attack it, but I just think that people don't see that there's other opportunities out there in terms of indicators that they could use. It's sitting right under their nose, simple to understand, very primitive, and that's all they really need to work with. Others may have different opinions, I'm not sure.
I think, Brian, it's not that simple. If it was that simple, you wouldn't have serious hedge funds like Minton losing money.
Yeah, I can't argue that.
So there is not a single golden formula.
Yeah, I agree. But it also depends on your trading strategy. In my case, if I'm just doing long and short on an equity, there may, I'm not saying there is, but there may be a certain way to trade it. I don't know. I have to test. That's all I can say. Anybody else? Questions, comments? Anybody?
I guess, you're talking about win ratio. What
Yeah.
about risk reward? Like, do you set your stop at 1 unit and your profit taker at 2 units? So 1 to 2 risk reward, that kind of rolls in with your win percentage.
Yeah, but that's the thing with automation, is that you have the ability to assess. Maybe sometimes you may not want to apply a stop loss. But if you can use a way to automatically calculate your stop loss ratio, that'll work for you. But I don't know if you can apply a hard set of calculations on it. Does that answer or does that address the comment?
Yeah, no, I think that's where I'm at these days. I'm looking at Euro USD Forex just for a few reasons. One of them is trades around the clock. But if you took like a 10 or 15 pip move and you say, okay, I'll get out after 15 on my side, but close off 5 pips on the loss, and just look for patterns where you see that happen. And I pick 15 because anything smaller, because of my commissions, will just get swallowed when I'm wrong.
Yeah.
I think it's very simple. I mean, many people will try to capture the maximum risk. Just capture something that makes you happy. Just stick to that. They say you make trades only of 5 pips, if you could. Just capture on that and just get out. Doesn't matter if you continue trading like crazy. Just make enough money and get out. That's the mentality of a good gambler.
Can't argue that.
I mean, the worst enemy of most casinos are not the most successful players, but the ones that go when you do it, get out. Because you accumulate your profits. Now, that's the whole point of good risk management. It's not like you have the biggest wins, because big wins usually get followed by big losses at one point. Just accumulate the profits, and that's why most market makers, besides the whole, the whole thing of high frequency, and they're able to trade in other conditions, their profits are minuscule, but they just do it in a continuous way.
Yeah.
I'm wondering, are there some metrics that are just useful for system development, like win-loss ratio? It seems like that's something that, as you're developing your system, you really need to keep track of that. But once the system is developed and you know it works, then it's basically P&L that it makes more sense to track than win-loss ratios.
Yeah.
I think you can do something very simple. Take your best win and take your worst loss and subtract the two. I mean, as simple as that. So, or you just take again your average and subtract the two. Just want the average win always to be more than average profit, or the skewed win to be more than the skewed profit. Skewed loss, sorry.
Well, that's basically like net P&L, basically, right?
Not necessarily. It's more like, I mean, but I take the two extremes. You're just trying to see like how it would have been in the worst case scenario.
Right. Or worst case so far, at least, right?
Yeah. Or you want, to take from your losses, penalize yourself more. Just take maybe 2 deviations of your losses. So just increase the average losses to see how still you will have traded.
Yeah. It just seems to me like
The win-loss ratio doesn't seem to make a... Once you have a system in production that you know works, the win-loss ratio doesn't seem to be so important as it's just basically net P&L, daily percentage drawdown, daily volatility of P&L. I think, like you said, LQ.
Yeah, it's just easier. And
Yeah.
And the thing is that people try to create crazy measures, and there's no reason. It all comes down, in my opinion, there is much more importance in the risk within the trade than just the result of the trade.
Mm-hmm.
I mean, I've seen trades of people on my FX book, which was insane. People claim that they have, I don't know, like 900% in a month. But if you see their trades, or just follow the trades, historically, at some point the trade was losing 150 pips. That's insane. Just because the guy again won 50 pips doesn't mean a thing.
Right.
Yeah.
Yeah. Very true.
Anybody else got any questions or anything? We're just over 2 hours now. Edwald asks, you want to keep an eye on the number of losses in a row that you expect from backtesting to give you an idea when your system is broken, you need to take it offline.
I was about to say exactly the same thing, just to see pretty much how many losses would increase your portfolio by X%.
Oh, there's one more risk measure which I forgot about. It's not a very common one. Do we want to keep an eye on a profit? Like, let's say if we had a huge profit in the week or for the month. Sometimes people will turn off their system if the system is very profitable in a certain period of time. thinking that it's not really going to get any better. So they figure like there was so much upside in the system, there can only be downside now. Like some traders, if they make a certain amount during a month, they don't trade anymore because of their statistical analysis they did on how much is feasible for them to make during a month.
I personally, if I would just be looking at momentum on the opportunities that you have in front of you that's current, and if the opportunities still point in your favor, why wouldn't you still continue trading?
Yeah, I mean, that's certainly a valid way to look at it. I'm just saying some people do shut off their systems if they turn out to be very profitable.
Yeah, I mean, Edwell just chimed in. He said, no, you want to keep the run of the table. That's what you want. So it's, I guess, is what I'm saying is saying what I just said.
Yeah,
No, for us it's different. For us it's different. We make our money. We just start for the day.
Oh, so you do look at profit, and if you're profitable to a certain level, you just turn.
When we have a target profit, you hit it. Doesn't matter if you hit it in 1 hour. If you hit it in 1 hour at the beginning of the day, you're out.
Yeah.
So LQ does that. LQ does do that. Okay.
I think it's better.
Yeah, I agree. It's good to have a target, and then you know.
Right. Yeah, that's for intraday, but I'm referring to, I guess, two different time horizons. If you're long term, yeah, you want to keep that bet going. But if you're intraday, yeah, if you have a daily target, get out, and once you achieve it.
No, I think just having a target just makes your life a little easier. That's one thing.
Yeah. What happens though what happens if you're a long term trader, like holding a position of, let's say, 10 days? I mean, can you really use daily?
That's different, Brian. I mean, that's
what I was thinking. Yeah, that's what I was thinking.
That's different.
Yeah.
Well, I was curious about LQ. Do you have a weekly profit target and a monthly profit target?
Daily, simply daily.
All right.
Because everything has been calculated from the point of view of the year's return, so we know how much we have to make daily.
Okay.
Anybody else got any questions? We're down to like 6 of us, I think.
Yeah.
We're just pushing over 2 hours. Edwell, you got anything you'd like to add? And Mr. M. Wiseman? Because 2 hours is a good time span. Last time with Mr. LP, we did 3 hours. You hear people getting tired. I guess not. What do you guys want to do? You want to continue, or do you want to give her a wrap?
I'm pretty much good. Thank you, LQ.
Yeah.
I appreciate it.
No problem, Shalom. Thanks for coming out.
No problem.
You guys want to continue, or Edwell asks, what happens when the market's slow? You don't meet your daily target. Do you extend the target?
For me, no, it doesn't make me.
Yeah, I guess.
No, I mean, our strategy works than first one market. On the quick or on the normal market, just finish your day faster.
Anything else, Edwell? You want to ask
I mean,
anyone?
people when you're doing the trades, the trades are half an hour, or well, if you're trying for maybe, I don't know, 7, 8 weeks, and you're prime broker, that'll be fine.
Yeah. Anybody else got any questions or concerns? 'Cause we're just doing 2 hours. It was a good meetup. We got another one coming up next week. I think it's next Monday again. Just out of curiosity, how many of you guys are coming through Meetup or Facebook?
I was just trying to
No, I know. Okay, Edwell's Meetup. Anybody from Facebook? Just doing a little survey here. Meetup. Okay, I'll assume all meetups. I'm just trying. Okay, our next meetup here. I'll put the link in there if you're all Meetup. It's on idea generation and indicators. So hopefully that'll be another good one. All right, let's give this one a wrap then. Anybody else got any questions or comments at all? I always do the going once, going twice, going 3 times. Okay, I think we'll call it a night. Thanks again, everybody, for coming out. Thanks again, Mr. LQ and Shalom and everybody else, Jeff, that was part of this webinar.
Thursday.
Okay, man, let's give it a wrap, and we'll hopefully see you next Monday again. I'll hopefully do these more weekly on Mondays. Same batch time and all that. Okay, so I'll see you guys later, all right? Have a good night.